If you understand market structure and key levels, you will be trading in profit. So in this video, I will show you how to identify market structures and the price action secrets behind key levels and market structure. So make sure you watch to the end. First, what is a market structure? So a market structure is the behavior and the current flow of the market. So when you observe the market, you see things like higher highs and higher lows, or the market is making lower highs and lower lows, or maybe the market is making equal highs and equal lows. That is just telling you the behavior of the market. It's telling you the flow in the market presently. If it is making higher highs and higher lows, it's telling that the market is in an upward trend. And if it is making lower highs and lower lows, it's telling that the market is in a downward trend. And if it is making equal highs and equal lows, it's telling that the market is in a sideways. So that is market structure, okay? And you need to understand it to know how you approach your market. Now, what are key levels? Key levels are the places where price previously found a resistance in an upward trend or found a support in a downward trend. And price could possibly reverse or begin to go down from that point in the future. That is a key level. You need to mark it out in your chart. It's important. So a key level consists of supports and resistances. So what are the price action tips or secrets behind key levels and market structure? So let's look at it again from this point of view. Number one, in an upward trend, buyers consider price as expensive when it gets to a key level, which is the resistance. So at that point, when price gets to a resistance, the bulls see the price as expensive and begin to sell their long positions. They begin to offload their long positions, leaving room for more sellers. And as a result, the price drops from that key level. That is the reason why at such a key level, the price drops. That creates a market structure. The tip there is when you are approaching a key level in an upward trend, be very much aware that sellers could increase and that buyers could offload their long positions, and that the potential of sellers taking the price down is high. So
no buying at resistance.
For the sellers, once price is approaching a key level, which is a support, sellers will begin to see the price as cheap, and they will begin to offload their short positions and begin to pick long positions or stay away from the market. Now, when they offload their short positions, then it increases the number of long positions in the market, and as a result, bulls takes over the market at the moment and price begins to move up again. So the trick there is that when the price is moving close to your support, which is your key position, you don't sell. You don't sell when price is getting close to your support, because the possibility of the bulls taking the price up is very high. So that is the trick. So to make good use of those key positions and structures, here is what you do. First, identify a structure. If it is in an upward trend, the market structure is marked by higher highs and higher lows. Whenever a key level is broken, a new structure, which is a higher high, is formed, then you don't jump in to buy at that point. You allow the price to move down backwards into that previous key level that was broken, which was a resistance but now turned support. And when price returns back to that point and there is a confirmation for you to buy, so you can buy from there and join the price to the most recent key level
or even higher.
In the same way, if the market is in a downward trend, it forms lower lows and lower highs. You wait for price to move back into the previous broken key level. Then you look for short opportunities here to short the trade. So here is an example of GBP, JPY 1 hour time frame. This is an upward trend making higher highs and higher lows. Now, what you do in this case is this market made this high here, broke the previous key level. This was a key level. And when price broke this previous key level and moved up here, you will allow the price to return back to that key level and see that that key level is holding strong. Then as the price comes up above that key level here, is an indication that that key level is very strong. So you can buy at this point and put your stop loss just below this recent retest of that key level, and that price that would have given you a very good profit here. Looking at this gold, we found out that we had our most recent key level here, and we saw that as price broke down, later price rallied back to that key level. When price rallied down to that key level, price was rejected and it dropped back below it, and a short trade from here with a stop loss just above here would have given you a very profitable trade. This is how it would have gone. So key levels are very important, and right now we are having a key level here right now, and price is bouncing into it presently. So what a trader needs to do is to allow this price to move into this key level and wait to see how it reacts, and then see the price come back again and close below this key level. Then the trader will pick his short position and then join the trade to the downside. So that is how you make use of your key levels and your market structure. You may even add your Fibonacci. If you add your Fibonacci retracement to this, when you do, you'll find out that this market is approaching the 50% Fibonacci retracement. So when it gets to that 50% Fibonacci retracement, you will observe what it does. If the price can come down from here and close below this key level, then one can pick a short position and put the stop loss just above that reversal. That's a most recent rejection, and then short to the downside. So that is how you trade your key levels. So thank you for watching. I appreciate your comments.